The largest retailer in India are not these companies, but Reliance Retail. But Reliance Retail is not listed on the National Stock Exchange or the Bombay Stock Exchange. So there is no way to actually invest in it. But there is a way. You can buy the shares for 2,600 rupees, and the price of that 2,600 rupees, wait, I just won't tell you. Why don't you guess in the comments below? Where did that 2,600 become after a few months? I'll give you the answer in the end, but before that, I have to tell you, how do you acquire shares of any company, Reliance Retail, Swiggy, Zepto, in the grey market, where the company is not even listed yet, so you can own it before the IPO. But in true Prateek Singh style, we will try to tell you all of the risks involved towards the end. So don't forget to watch the video till the end for the risks and to understand how that price from 2,600 went to, well, you should guess. So the grey market is basically a bunch of normal people buying from each other. It could be someone who is working at Zepto, has the ESOPs, and that vested ESOPs is sold to another party. It could be a broker who has access to these shares and gives it to someone else. Basically, the unregulated market, where it's not on the stock exchange between people, is what the grey market is. And since it's unregulated, it's neither illegal or legal, it's grey. That's why it's called the grey market. A lot of people start talking about the grey market before an IPO. The thinking is this, and always this is greed thinking, which I always hate, that people think they can buy the stock before the IPO, and if there's a listing gain, they'll sell it and they have liquidity and they'll make a lot of money. But obviously there are some risks on this we'll talk about in the end. Right now, let's just talk about how you can actually acquire these shares. There are two terms you need to understand. First is the Kostak rate. This is simply the price agreed by a bunch of people on what the price of the share should be. It's called the Kostak rate. Second is the grey market premium. This is usually expressed in a percentage. It could be 5% or 10% and is on top of the existing price, on top of the existing Kostak rate. So basically, if the Kostak rate is 100 rupees a share and the grey market premium is 20%, that would mean 120 rupees per share. Now, people start looking at the grey market premium because it gives you an idea on what the listing gain will be. So if the grey market premium is 30%, people expect the company to list at a 30% premium. Why? Because price discovery is already unofficially happening between brokers and other people in the grey market. However, this is just a thinking. It's not actually true, and we'll tell you the truth at the end of the video. So first, let's talk about how you actually acquire these shares. The first way is to go to multiple websites and actually purchase it. So there are a bunch of websites. It's called the applications market, where you can possibly buy unlisted shares. For example, Chennai Super Kings. Yes, it actually trades unofficially in the grey market. The second way is the more human approach, the traditional approach. You can go to a large broker who's been there for a long time, has a network, and can possibly acquire it for you. You can also find a person directly, a person working at that company who has ESOPs, or maybe the promoter, and purchase it directly from that person. But why would you try to acquire these shares in the first place? And here are some advantages. The first advantage is that you may be buying into a fundamentally strong company which not a lot of people have access to and may go public in the future. For example, HDFC has HDB Financial Services, which is actually a decent company, not listed on the stock exchange. The second is, say, Reliance Retail, and then there's this third one, which are also good companies. The second reason could be that you're trying to get this at a discount from what it could be at IPO. But there's a small little knick-knack here I'll tell you at the end. And everyone is aiming for that. You might get a discount and maybe there's an advantage here. And the third is, well, not really for people like you and me, but for HNIs. And HNIs may want to invest 50, 100, 200 crores in a single shot for a company. It's really difficult to do that on the public market because of slippage and not finding a seller, etc. So they can do this route to actually get a flat price and enter their entire amount in one shot. Now let's talk about the disadvantages, my favorite part. The first is that there is no regulation. SEBI is probably one of the best regulators in the world, and we should be lucky we have them for India because they do a lot to protect us investors. If something goes wrong in such a transaction, there is no one that will stand by you because SEBI does not have this grey market under their purview right now. And that is a serious disadvantage. For example, we all saw this movie as kids jahan pe Paresh Rawal and these two smart guys wanted to double their money very quickly and gave it to this chit fund, and the chit fund one day vanished. And the only way for them to ask for help would be to cry, because there is no regulation for that situation. And you don't want to be in that situation either because there is no regulator right now. It's a grey market, the risks are high. The second is price discovery. Now, when you go out into a vegetable market, you know you're getting the best price for your potatoes because there are 20 other sellers over there and no one can overcharge you because, well, they have competition. And Adam Smith's hand helps you get the best price. Here, there is no price discovery. It's a bunch of guys deciding what the price should be, and you may not be getting the right price. The other thing is volatility. There could be one single investor which comes in, says, I don't think your company is worth X, and he gives a term sheet, it is signed, the funding happens, and the price could completely change based on the opinion of one investor. That's kinda risky, especially when you see startups where other people discount and change the valuation pretty quickly when markets change. And markets change all the time. It won't be in your control. And I think that's a risk as well. And the third is Reliance Retail as an example. Remember I told you the shares were unlisted in the grey market, available for 2,600 rupees only. And you guys probably put a comment. You know what happened to those shares? That 2,600 is now around worth 1,300 rupees. Why? Because Reliance Retail one day said, hey, we are buying back some of these shares and due to XYZ reason, we are repricing it at 1,300. Take it or leave it. If you had bought those shares thinking you bought a great company at 2,600 and the re-rating happened, you'd be sitting on a massive loss. Therefore, the lesson learned here is if something isn't regulated, you probably should not put your money in it. Even if you're getting a great deal and a great company like Reliance Retail, the problem isn't with the company, it's that it's not regulated. But if you do think this is interesting, you can allocate a really small portion of your portfolio into something like this, just that now you'll do it a little smarter because you understand the risks, not only the rewards. But why does this market exist? It exists for highly risk-taker people, also known as HNIs, who know how to divide their capital, have their nest egg safe, and want to put a few chips into some things like this and don't mind it going to 0 or down 50% because they've already calculated the risks. Let them do it. Unless you're Bruce Wayne and you think you want to buy the hotel, don't do stuff like this. Instead, I was thinking, why don't we cover stuff outside of stocks? And this was just a hint. These were unlisted shares. What if we talk about shoes and other alternative investments like paintings or Rolex watches or vintage cars? Can we actually make money in it? We thought of creating a series called Alt Investing. Do you think that's a good idea? Put it in the comments, hit the like, hit the subscribe. If we get at least, 20 people saying we should do it, we'll create that damn series. Put it down. I look forward to your comments. If you thought this was interesting, you know what to do. See you in the next video.